In a world constantly in flux, financial markets serve as barometers of economic health, responding to a myriad of influences ranging from geopolitical shifts to macroeconomic data. As the global economy treads a fine line between growth and contraction, the latest movements in Asian markets underscore a climate of apprehension. Investors are on edge ahead of a crucial U.S. inflation report, with many markets experiencing significant declines. This anticipation reflects broader concerns about interest rate trajectories and economic stability, particularly as high rates continue to impact global markets. The economic uncertainties are further complicated by regional issues, such as China's efforts to revitalize its struggling property market and Japan's currency fluctuations. Amidst this backdrop, Wall Street shows resilience with technology giants like Amazon and Nvidia driving gains. However, the overarching question remains, can central banks balance the delicate act of controlling inflation without stifling growth? As we navigate these turbulent waters, how can investors best prepare for the potential economic shifts on the horizon? Navigating economic uncertainty, Asian markets react ahead of U.S. inflation report. In the intricate dance of global finance, market movements often serve as indicators of underlying economic sentiments. This week, as Asian markets brace themselves for a pivotal U.S. inflation report, a wave of apprehension has swept through, leading to significant declines across various indices. The much-anticipated personal consumption expenditures, PCE index, the Federal Reserve's favored inflation gauge, looms large over the financial landscape, holding potential implications for future interest rate decisions. On Thursday, major benchmarks in Tokyo, Hong Kong, and Sydney each fell by over 1%, reflecting a broad-based sell-off. This downturn in Asian markets comes on the heels of mixed economic data, leaving investors in a state of heightened alertness. The PCE index, set to be released on Friday, is expected to provide critical insights into inflationary trends and influence the Federal Reserve's strategy on interest rates, which are currently at their highest in over 2 decades. The global impact of U.S. monetary policy. The repercussions of the Federal Reserve's interest rate policies extend far beyond U.S. borders. High interest rates, aimed at curbing inflation, have profound impacts on global markets. They affect everything from borrowing costs to investment flows, creating ripples that can either stabilize or destabilize economies. Investors are acutely aware that the upcoming PCE report could signal shifts in these policies, potentially leading to a recalibration of financial strategies worldwide. In Asia, markets are particularly sensitive to these developments. The Hang Seng Index in Hong Kong dropped by 1.9% to 17,746.53, while the Shanghai Composite Index fell by 0.5%. This decline was exacerbated by ongoing challenges in China's property market. Despite recent efforts by Beijing to stimulate the sector, including reducing minimum down payment ratios and mortgage interest rates, investor sentiment remains subdued. These measures, though significant, have yet to reverse the downturn triggered by the government's crackdown on excessive borrowing by property developers, a move that led to widespread defaults and a sluggish real estate market. China's struggle with economic revitalization. China, the world's second-largest economy, is grappling with a prolonged slowdown in its property market, a key driver of economic growth. The government's recent policies to lower down payment requirements and mortgage rates in major cities like Beijing aim to reignite buyer interest and stabilize the market. However, the effectiveness of these measures is still uncertain. The property market's health is crucial not just for China but for global supply chains and international trade, making its recovery a matter of global economic importance. In Japan, the Nikkei 225 index saw a 1% drop to 39,286.97, partly driven by concerns over the weakening yen. The U.S. dollar's rise to 160.43 yen has prompted warnings from Japanese officials about potential market interventions. A weak yen can have mixed effects. It makes Japanese exports more competitive, but also increases the cost of imports, complicating economic management. The balance Japan must strike between these opposing forces adds another layer of complexity to the global economic picture. Wall Street's resilience amidst global uncertainty. While Asian markets waver, Wall Street has shown a degree of resilience. On Wednesday, U.S. stocks saw modest gains, with the S&P 500 inching up 0.2% to 5,477.90, and the Nasdaq Composite rising by 0.5% to 17,805.16. This stability was bolstered by strong performances from major technology firms. Amazon.com in particular surged by 3.9%, surpassing a market value of $2 trillion. This milestone comes shortly after NVIDIA's brief ascendancy to a $3 trillion valuation, underscoring the significant influence of tech giants on market dynamics. Despite these gains, the broader market sentiment remains cautious. About 65% of the stocks in the S&P 500 declined, reflecting underlying concerns about economic stability. Companies like FedEx and Rivian provided some relief, with FedEx reporting better-than-expected quarterly results and Rivian benefiting from Volkswagen's substantial investment. These instances of corporate success highlight the mixed landscape of winners and losers in the current economic climate. The path forward, balancing inflation and growth. The overarching challenge facing central banks, particularly the Federal Reserve, is finding the right balance between controlling inflation and fostering economic growth. The persistent high inflation has forced the Fed to maintain elevated interest rates, which, while curbing inflation, also risk dampening economic activity. Wall Street is hopeful that the Fed will begin to cut rates soon, possibly as early as its September meeting. However, this decision hinges on achieving a delicate equilibrium, easing financial pressures without derailing the ongoing economic recovery. The resilience of the U.S. economy, despite high borrowing costs and inflation, offers some optimism. However, signs of stress are emerging, with consumers increasingly shifting their spending towards necessities. This change in spending behavior signals underlying economic pressures that could potentially slow growth further. Commodities and currency movements. In the commodities market, U.S. crude oil prices saw a slight decline, with benchmark crude falling by 21 cents to $80.69 per barrel, and Brent crude, the international standard, dropping 19 cents to $84.28 per barrel. These movements reflect broader market uncertainties and the complex interplay of supply and demand factors influenced by geopolitical and economic developments. Meanwhile, in the currency markets, the euro strengthened slightly against the dollar, rising to $1.693 from $1.681. Currency fluctuations continue to play a crucial role in global trade dynamics, influencing everything from export competitiveness to inflationary pressures. A global tapestry of economic interdependence. The current state of the global economy is a complex tapestry of interdependent factors. From the U.S. inflation report that holds sway over interest rate policies to China's efforts to stabilize its property market, each element influences the broader economic picture. As markets react to these developments, the interconnectedness of global economies becomes increasingly apparent. In this intricate web, investors, policymakers, and businesses must navigate carefully, balancing short-term reactions with long-term strategies. The upcoming U.S. inflation report is just one of many pieces in this larger puzzle, but its impact could be profound, setting the tone for economic policies and market behaviors in the months to come. As we stand at this juncture, the pressing question for all stakeholders is, how will the interplay of these global forces shape the economic landscape moving forward? In a world where financial stability and growth hang in the balance, what steps should we take to safeguard our economic future? Share your thoughts on how we can best navigate these uncertain times.